Hello there. Well, of course, the news headlines recently have been dominated by what's happening in the Middle East. And of course, that's having a major impact on people in the Middle East and their families, and we shouldn't try and trivialise that. But of course, you've entrusted us to look after your wealth, and so we have to consider the financial impact. The most obvious financial impact that we've seen so far has been on the oil price. You know, from before the conflict started at the end of February, oil was about $70 a barrel in terms of Brent crude oil. At one point after the conflict had begun, it went as high as $120 a barrel, and today it's roughly around about the $100 mark. So that's still quite a lot higher than it was at the start of the conflict, and we've seen similar volatility and big increases in things like the gas price and all those sorts of things. So what that means in terms of the economy is potential inflation. An increase in the oil price is likely to push inflation up a bit, and it might dampen global economic growth too. And of course, that has an impact on investments. And one of the ways that it then impacts investments is through interest rates, because of course, the Bank of England and other central banks are meant to try and keep inflation below a certain level. In the case of the Bank of England, it's 2%. And so what they would normally do, if inflation was fine, if everything was sort of below target or coming in the right direction, they might be inclined to cut interest rates. And that's what everybody was expecting, all investors were expecting the Bank of England to do before the conflict began. In fact, you know, they were expecting almost certainly we were going to get a rate cut this month. Now, because of that shock to inflation, if you like, that is unlikely to happen. We think interest rates are unlikely to go down over the next few months. They may even actually have to go up later on in the year, or at least that's where investor pricing has gone. So it's been a real turnaround, and that has an impact on lots of asset classes. So we've seen equities go down because of concerns about economic growth, but also bonds go down a little bit because of concerns that interest rates won't be cut and may even have to go up. Now, all of that, of course, brings back memories of 2022, when after the Russian invasion of Ukraine, again, we saw big increases in energy prices, and that was compounded by all the stimulus, if you like, that governments had been doing during COVID, and all of that combined to give us very, very high levels of inflation. Well, I think it's really, really important to emphasize it is not 2022. Things are very, very different than they were back then. So yes, at the moment, if the oil price stays high, that might cause inflation. It's unlikely to be anything like what we saw back then. The other thing that's different now is just the starting point of where markets are at, particularly bond markets. So coming back to what I said about interest rates, going into 2022, Bank of England base rate was 0.25%. Today it's 3.75%. So we're starting at a much higher level. So even if rates have to go up as a result of inflation, and that's not what we're expecting, but if they do, then probably go up a little bit. You know, even if they go back up to where we saw during 2022-23, 5.25%, that's not such a big impact from where we are today at 3.75, as it was back in 2022 when they were 0.25. In a similar vein, government bonds. Back in 2022, the UK 10-year gilt yielded about 1%. Today it's about 4.75. Corporate bonds in 2022 yielded 2%. Today they're about 5.75. So the yields are much, much higher. So if interest rates go up, which normally isn't great for bonds, it shouldn't have anywhere near the same impact as we saw in 2022. And generally, the underlying economic data has been pretty good. So if it weren't for the conflict in Iran, then we wouldn't be particularly concerned about that at all. So it's not 2022, it's not a repeat of that. However, inflation can have an impact on portfolios. So what are we doing about it? Well, going into this conflict, we had positions in things like inflation-linked bonds and things like utilities. And the utilities, it would include things like power companies. And they tend to do quite well if energy prices go up. And the reason we were holding those things is because we knew that inflation was one of the risks that we had to think about in terms of managing portfolios. That if inflation came back, it could have a negative impact. So we've always been looking at what we should do, what we should hold that might mitigate that impact. Recently, we've also added to inflation kind of protection, if you like, by buying a commodities ETF. It basically means a fund that tracks the commodities index. So and you should think of that as like an insurance policy. So if the oil price, the gas price carries on going up, that would have a positive impact on the commodity index fund that we've bought. But also we're thinking about the potential knock-on effects, because higher energy prices could lead to higher fertilizer prices and higher food prices. So all of those things could have an impact. And it's not that we're saying we can predict where those things are going to go, but just holding a small amount in portfolios as a kind of insurance policy seems to make sense. We also have what we call a put option, which essentially is another way of providing some insurance in the portfolios. And essentially what that means is if the stock market go down, in this case the US stock market, then that would probably go up in value, and it would kind of offset or mitigate some of those losses. So we've been looking at those sorts of things all along. We also look for opportunities whenever we see any sort of crisis, if you like. If markets dip, as usual, we'll be looking to say what is the best time to buy in? Are markets now looking cheap? Are they looking better value? Can we buy in at a lower level, which hopefully will then see a rally, and that will help long-term returns? And we've sort of started to do that a little bit. It's been helped by the fact we had a couple of our defined returns products kick out. We've recently reinvested some of that into a new defined returns product, and that will give us a 12.5% return, essentially if markets go sideways from here. But in essence, what we're finding is there are things that we can do that hopefully should protect the portfolios on the downside, and generally our core funds of cautious, balanced and adventurous are all falling less than the typical mixed investment fund over this time frame. And we're also finding that there are ways that we can seek opportunities to take advantage of volatility. So as usual, we'll continue to look for those, we'll continue to watch things carefully, and we won't hesitate to act further if required. So I hope you found that useful, and we'll see you again next time. Thanks a lot.